So what does a money press look like on Boeing? Well, first of all, we're going to go out to the next week, and we have $2.50 increments on the strike prices. So an at the money would sport about $2.80 premium. And that's pretty much at the money. It's slightly out of the money. But in trading something like this, where I'm inclined to go, and this might jibe with you, you might not, it might not. But where I go when we have upslope, we have an accumulation in the market cycle, which is healthy for stocks. We have a recent setup in the stock. We are patient, waited for some profit taking. Then Boeing's dealt with this week, just like other stocks, trading a little higher today. I would trade this just a little more to the aggressive side. And given the fact that we only have these strike prices to deal with, right, $2.50 increments. But my eyes go to these 235s. Again, this is for next week. Money press, of course, we deal with the idea how we set up the trade and how, well, you know that we sell a weekly put and then we buy a protective put and we buy that out in time, and the strike price, so if we sell the weekly, and this is on BA, if we sell the weekly 235 put, we'll do a limit order in there, and we'll go inside that spread and get it for, we'd sell that right now for like 410. Why sell it for 4 when you can fish around and try to get a better price in that bid ask, which is what the rest of the world's doing? So this is one half of the money press. And then the other one is we'd buy, and we do an equal amount of contracts. So if we did 10 contracts of selling, we would do 10 contracts of buying. So we would buy. And here's the little vocabulary too. So sell, well, in the options world, you know, you're selling something that you don't own. This term here is called sell to open. Sell to open. I'm selling to open this position here. Okay, you're gonna have to work through mentally that you're selling something that you don't own. It doesn't work so well if you walked into a Lowe's up the street here and just walked in the store and started selling stuff. I'd like to sell that chainsaw. I'm going to sell that lighting fixture right there. And right here at checkout, I'm going to sell that WD-40 can, and I'll sell a candy bar. Okay. They would probably, if you were saying that out loud, store security would be on you. But in the options market, it's like, oh, hell yeah. Oh, of course. Sell something you don't own. Well, we get it. That's called sell to open. Okay. And the idea here is we're going to do the same amount of contracts, and we're going to buy this one. So both of these are called what they call in options terminology, legs. So this is a leg. This is a leg. And the actual term for the money press is, you don't even want to know it, but it is so crazy and convoluted. It's like, it's a put credit vertical calendar put credit spread. I think I said some of the same things twice there, but it's super crazy. And I lost my train of thought. Oh, but all to say that money press is just the cool way to say it. Okay. So so we're gonna buy something here, and they're gonna be puts too. They're gonna be puts, and they're gonna cost a certain price, but they're not gonna be weekly. Okay. They're not gonna be weekly. So what are they? Well, we're gonna buy something out in time, and let me get my pointer back here. We're gonna, if we look at Boeing right here, BA, we see that their next earnings announcement is going to be late October. So what I look to do is I at least want to cover the next earnings announcement date. Okay, and why is it October? Because they just announced it like 10 days ago. Okay, so if we go out on the option chain and look at our months here we are. So October, and Fidelity kind of, it's not a confirmed date, but they kind of pencil in when the next earnings is on these months, which is kind of fun. So I would want to go out to like November, so August, September, October. Can you believe? I can't believe September. I can't believe September, October. I can't believe freaking Thanksgiving is getting to be like 3 months away. Oh man, I'm gonna have to sit with that one. But November would be a solid expiration. And let's just look at these. So these are November, 105 days out. So we have another piece of the puzzle we're going to ink in here. November. So we're going to sell to open 10 of next week's 235 puts. We're going to buy, let me get my pen here, buy to open. And so do you do these orders at the same time? Well, yeah, it makes it easier. It's called an option spread consisting of two legs. So just remember that one leg and one leg makes you stand. Your legs are spread and you're standing. Buy to open November puts. And now we're going to choose what this number is going to be. And I'll tell you something, first of all, is that this strike price that we're going to choose here is always going to be less than this strike price right here. Always. Okay. So does that mean 230 is the right one? Does it mean 100 is the right one? Okay. No, both of those are lower. So both of those are semi-right, but how we drill down and choose this number here. And first of all, you have to realize something, that when we go out in time, when we go out in time in the options world, we're going to have more choices when there's with shorter expirations. When we get out in time for the longer expiring options, okay, and this isn't right or wrong, this just is. And it happens with pretty much all of them, from Tesla to Coke to Boeing, is they're going to have less. You'll notice here that we have $5 increments between the strike prices. That's what we have here. We don't have the $2.50. And the reason for all this is there's less trading that happens in these Novembers. Some of these don't have any volume out there. That's not right or wrong either. It's just a fact that the world, for some reason, beats a crazy path to the shorter expiring options. That's where the volume is. That's where they give you more choice. And consequently, it's why some of those short-term premiums are pumped up in value. Okay. So just take all this in. So what we like to teach here is our back of the napkin math is we like to take this premium, this weekly premium, double it in your head. That's 820. And I like to use this figure to space between our two strike prices. I like to use the double of a weekly premium and use that as our spacing. Now, this isn't always going to be perfect. So if you look at this, and this is why I talk about our strike prices are limited. In a perfect world, what would that be? That would be 220, it'd be 227. But if we come over here, we don't have 227 puts. We have a choice of 225 and 230. Okay. And in a market that's bullish overall, even though we had a pullback week, okay, I trade these a little more aggressively, meaning 230, I don't need all that protection, especially clear out to November, past the next earnings. Okay, I'm super comfortable with these 225s. If I wanted to get really scientific, guess what I do? I would buy 5 of the 230s, and I'd buy 5 of the 225s. And guess what that equals? That equals owning 10 of the 227.50 puts, which don't exist. But you can create and carve out your own strike price. And you could even, if you want to get really, really nerdy, you could do 6 of one and 4 of the other, 7 of one and 3 of the other. And I know some of you probably have a spreadsheet out there that will just crunch it like that. And if you wanted to get close to 228, you could, but look, all that's just kind of crazy. Okay, but you could totally do it in a, I would say in a little, I would say if we weren't just coming out of a bear market, okay, and we are kind of wish-washy and like, wow, where's the bottom or whatever, I probably would do 5 and 5, 230 to 225. But in this type of market, I'm fine doing 10 of the 225 puts. Okay, so I know that I'm getting kind of I'm just scrolling here, but if you're following this, what do these go for? If we bought 10 of the 225 puts, well, there's the bid and ask for that. And could we get a better deal if we barter inside the bid ask spread? They want to charge us $9.25. Could we try to put $9.15 in there or $9.20? Hell yes. You're always going to go for a better price. Are you freaking kidding me? Some people are like, oh, what do you mean by getting a better price with limit orders? You've got to be kidding me. This is a market. They're selling, they're dealing and wheeling and dealing in options. We're selling options, we're buying them. Get a better price with limit orders. I don't get that question. I mean, wow. Oh my gosh. So they want $9.20 for this. So what I'm sharing with you here is, first of all, we picked a stock, and hopefully we don't result in a 5-minute wallow next week. We've got a setup. Why the stock? Why now? It happens to be Boeing. We're kind of judging. I'm so exercised. My fake pen hit the ground. We are we're keeping market cycle in the back of our mind, that's bullish. Boeing's just freshly broken out. We've let it have some time to wiggle around after that really big announcement. So that's why so all to say that we started here, then we worked around to what month and what strike price we needed. And the last thing was what this price happened to be. There is zero correlation between us selling this weekly and saying, let's go find a good price. No, the price is incidental. We build our money press by, first of all, our ticker, and then, okay, we're going to sell this. We happen to get this in. This comes around. We get our month. We have to choose our strike price with the spacing, and then it happens to cost $9.20.